Global markets shaken by the conflict between Israel and Iran. Iran reportedly describing Israel's strike as a declaration of war. Israeli Prime Minister Benjamin Netanyahu says the fighting will last, quote, as many days as it takes, end quote. And President Donald Trump is urging Iran to reach a nuclear deal in the wake of these attacks. Joining us now with his insight on the matter, we've got Mark Ginsburg. He is currently the president of the Coalition for Safer Web, as well as the former ambassador to Morocco and former White House Middle East advisor here. Good to have you here. Thank you for taking the time. So first and foremost, just take us into what your immediate thought process would be after hearing the commentary from the Israeli Prime Minister Benjamin Netanyahu and also seeing what played out overnight.
The Israelis have essentially done three things here in their initial attack. One, they did an incredible job decapitating the military leadership of Iran. Number two, they did some damage to one of the major nuclear sites in Natanz, but they haven't touched other nuclear sites in a degree that they would consider to be satisfactorily hit. And number three, they essentially did a Ukrainian gambit. The Mossad was able to infiltrate into Iran some facility that was able to permit them to launch drones inside Iran against these installations and Iran's defenses.
We do know that there are voices internationally sounding off on this right now. You've got India's Prime Minister Narendra Modi saying that they spoke with Netanyahu, urged peace in a post on X as well. We also have the Japan trade chief speaking to reporters as well right now in D.C. and many of them acknowledging this. And then, you've got the Prime Minister in the UK, Keir Starmer, saying that the UK has grave concerns about the Iran nuclear program here. Just synthesize some of the international reaction from the conversations that you imagine U.S. officials are having at the same time that, they were set to do a different type of conversation with regard to some of the tariff policy, and now it's this instead.
Look, Israel has been increasingly isolated from its allies over its war in Gaza, and Netanyahu essentially changed the equation by launching this preemptive attack. Israel would have continued to be isolated, but I suspect that most of the Israeli allies, including the United States, are privately commending what essentially Israel has done, because Israel has proven before that it is not willing to wait to let either Syria or Saddam Hussein be able to nuclearize uranium into a weapon. Now, what does that translate into? I think the only card that Iran has right now in terms of getting greater international support is to interrupt oil shipments out of the Straits of Hormuz. The other thing it's going to probably having to calculate is, does it somehow crawl back into a negotiation with the United States and resume a nuclear agreement negotiation this weekend? I find that highly unlikely, because it collapsed because the Iranians refused to cross the red line that the United States imposed on it, i.e., it had to export its uranium enrichment program out of Iran, and the supreme leader rejected that, and that's why, in effect, you see these attacks today.
I don't want to make you have to kind of read the minds of investors and of some of the strategists on Wall Street that have warned about black swan events or exogenous threats that could tank this market, but is this the potential match to that type, or the spark to that type of exogenous threats that the markets are very much concerned about, despite the rally back from the depths of the tariff policy turmoil that we had seen?
You've got an excellent point that you just made, because Israel has essentially stated that these are going to be rolling attacks over several days. If the regime considers that these attacks are targeting civil leaders, including the supreme leader, if they believe that the regime is now itself under threat, there's no question in my mind that Iran will try to, in effect, interrupt oil shipments in the Straits of Hormuz in order to gain more pressure on Israel. And you can be certain that that is the black swan event that I'm concerned about.
With this in mind, you also have President Trump, who has been taking to Truth Social throughout the night and this morning, evergreen, but at the same time talking about what Iran should be doing and pushing them to make a deal. Is there the likelihood that we see Iran make a deal, especially knowing what the president had been calling for what he says, 60 days now?
It's hard to calculate why would the regime resume negotiations with the United States when it already rejected the terms that would permit, what in effect would have required Iran to agree to join a consortium of the United States and other Arab states in which uranium would be enriched under their supervision outside of Iran. That would be seen as a complete capitulation from the position that the supreme leader has taken. Will Israeli military pressure force the Iranians to try to save face with that and give Trump an opportunity to try to get these negotiations back on track? Look, I think the next 48 hours will tell.
You know, you mentioned something really key, former ambassador, about the Strait of Hormuz, a disruption in the Strait of Hormuz. How long would that take to unwind if we did see that disrupt oil shipping routes, global energy supply and prices?
Look, all it takes is blowing up a tanker in the middle of the Straits to send the shockwaves around the world. Iran has more than enough naval capacity out of its major ports along the Gulf to be able to attack any shipments that are continuing, as well as to threaten to attack shipments, which would cause a huge escalation in maritime prices.
And so, all of this considered, what would be your checklist for watching either a diffusion of this matter or keeping tabs on what could potentially come next in escalations?
Whether or not the Israelis are able to declare that they did substantial damage to the key nuclear sites that it is targeting, and that remains to be seen. And so these rolling attacks are key. So that's point one. Point two, what is the Iranian response? They sent drones in to attack Israel. Almost all, I believe, were intercepted. Will they launch ballistic missiles against Israel's civilian centers and possibly target American forces? Those are the things that I'm looking at.
Former Ambassador Mark Ginsburg, thank you so much for joining Yahoo Finance this morning. We appreciate it.
My pleasure.
How are you thinking about all of these issues that we've been talking about? As we mentioned, geopolitical risk does not tend to have a lasting effect on stocks. However, if oil prices are going to stay elevated, well, then what is that dynamic then going to create in terms of a ripple effect?
And I do think that that's actually how investors have to approach this. You need to realize that at any given point in time, you do need to manage risks in your portfolios. And one of the things that you can do to manage risks is, properly align your investment portfolios with your goals and interests so that when you hit difficult patches, you're able to pull from the more defensive portions of your portfolio for spending needs and not touch the riskier portions. Because the reality is, the riskier portions, your equities, are the things that are going to get hit, broadly speaking, when there's a rise in geopolitical risks. There's another thing that we need to consider for geopolitical risks, and that is those items that are closer to the fray tend to get hit the most. Now, fortunately for a lot of kind of global investors, your exposure to Israel and Iran tends to be relatively small in portfolios, and therefore the direct linkage is a little bit looser. U.S. and other nations are obviously relatively distant from the actual conflict at hand. But then, as you mentioned, you kind of have to look over your shoulders for second-order effects. And second-order effects of higher oil prices feed into higher inflation, put the pressure on the Federal Reserve to keep rates a little bit higher. That can cause a little bit of difficulty on a near-term sense, and you need to be looking over your shoulder for that. We don't think that that is a reason to, in reaction to events as they're unfolding, change your investment plans in a dramatic way. In fact, we'd really caution against it because quite often we think that things are getting worse or bad at a time when it relates to international conflict. But international conflict is actually very, very difficult to predict. And we would argue that, well, there's a lot of pundits out there that want to try to tell you exactly where it's going. Their likelihood of being accurate on that is very, very low.
Well, okay, all of that, absolutely fair. None of us knows what's going to happen. But when you're looking at your portfolio, not necessarily in a reactionary sense, but how do you want to think around the role of things like gold and things like treasuries or even things like oil as you see things like this unfold? What do you want your exposure to be in some of these areas?
So first and foremost, because of that balanced nature of your portfolio, you'd prefer to have a fixed income portion in your portfolio in order to act as a ballast during the difficult times. The second thing that you want is you want international diversification. A global portfolio will own things that are not just in the area of conflict, but will own things elsewhere. And things elsewhere away from the conflict will probably do a little bit better at that point in time. Now, as it turns to gold and oil, there's kind of two thoughts and approaches here. Number one is that gold is a very imperfect hedge for inflation that's particularly related to the energy markets. Having said that, energy commodities or oil commodities are actually also kind of a suboptimal investment. So that's not something we tend to advocate. If anything that you would consider as an investor, we'd consider investments in the equity space and the energy space to try to benefit from those higher oil prices. And that is one way to diversify your portfolio in this environment on a longer term sense in the face of these issues. Again, there's no real perfect tool on this other than, we think, a little bit of fixed income exposure and diversification of your portfolio.
And of course, there's a lot of other things going on besides what's now unfolding. We have the trade negotiations that are continuing. We have the Fed meeting next week and sort of largely expected to continue to be in that wait and see mode. And so do you sort of apply that same playbook to some of these other events where we're not quite sure how it's all going to play out?
We do to some degree. Generally speaking, our perspective on the tariffs and this very large fiscal bill that's coming through, you can actually start to read the tea leaves just a little bit on that. The tariff negotiations, we think, by our estimation, are probably going to have about a 1 to 1.5% headwind to economic activity in 2025. But majority of that's actually going to be felt in 2025. This fiscal bill that's coming, interestingly, the contours of it looks like it's going to be marginally stimulative to the tune of about 0.5% per year over the next 10 years. But that stimulus is going to be concentrated in the first 4 years. And that concentration in the first 4 years will mean that there will kind of be an equal and opposite stimulus benefit from the bill coming in 2006 primarily as an offset to the tariff policy. The interesting contrast here of timing is a little bit of softness in 25 and perhaps as an acceleration in 2026. And we'd be a little bit surprised if markets didn't catch on to this as we head into the beginning of next year and actually heat up a little bit as a result of it.
And do you think we'll be getting a couple of interest rate cuts from the Fed in the meantime?
If our base case plays out, we're probably in the camp of about one interest rate cut for 2025, 1 to 2 in 2026, so a little bit slower pattern. And that's on this presumption that the tariff policies, the negotiations go somewhat well to get to our base case. And this fiscal bill comes through with this front-end loading of stimulus that we think the market and investors and a lot of business leaders will start to recognize coming into the start of the year.
Jason, thanks a lot. Have a great weekend.
Thank you.
Israel launching an attack on Iran's nuclear program and military leadership overnight. Iran retaliating with missile strikes of its own on Israel. The geopolitical uncertainty putting pressure on oil prices, which could then in turn have implications for President Trump's trade talks. For more, we're bringing in Mark Bush, professor of international business diplomacy at Georgetown University. Mark, thank you so much for joining us. And I know you focus on trade, but obviously everything is connected. And in particular, we know that this administration has had the wind at its back in terms of leverage from lower oil and gasoline prices. That changed to some extent today. How does that potentially feed into these future trade negotiations?
Everyone's looking for leverage. That's been the common theme of the recent negotiations, including with the UK, but especially with China. And so as you consider, for example, China looking to import potentially more energy, when you look at what should be expected with respect to the EU, all of these price fluctuations will have an impact on what Trump can credibly claim to be a source of leverage.
And as someone who served in the Department of Commerce and in the Office of the U.S. Trade Representative, how do these things sort of play out? We've seen some frameworks for these agreements being put in place. But as these folks continue to negotiate, whether it's the U.S. and China or some of the other partner nations, give us a little insight into the nitty-gritty of how the negotiators are thinking about this and how it actually works in these rooms.
So I was a cleared advisor on technical barriers to trade to Commerce and USTR for 6 years, and I got a chance to work with my committee on 2 big trade deals, neither of which came to fruition. These efforts today are not those. Those were real trade deals with a capital D. These are not trade deals with a capital D. It's almost hard to imagine them with a lowercase d. These are stopgap measures to avoid an escalation or to walk back from the brink. So these are very narrowly construed. They don't have nearly the input from a wide swath of advisors. This is really about walking back from the ledge.
So, Mark, for people who are not as steeped in this as you, how do they know if it is a capital D deal, right? What should people be looking for to show us that this is more than just, a memorandum of understanding or a framework to have a deal at a later date? What does a real deal look like?
So a real deal would be many chapters. Think about USMCA, which is some 35 chapters. Those chapters are on a wide range of issues, from health and safety standards, which are very popular to talk about these days as one of the key non-tariff barriers that the U.S. would like to deal with in our trade negotiations coming up. Intellectual property, digital trade, et cetera. Those are all chapters. We have texts, we have legal obligations. Right now, you're looking at troubleshooting. You're looking at, as in this past week, export restrictions and some means by which the Chinese share with us their rare earths. We share with them some software, some aerospace engine parts, et cetera. These are almost like Trump 1.0 barter deals to walk us to a better place. And in this go round, to de-escalate the ridiculously high tariff rates that we're seeing lobbied around almost with abandon.
So July 9th is the next sort of deadline that we're looking at, right? That was the end of the announced tariff pause. So what do you expect to happen by that point? Does it seem like those rates could go back up in some cases, or are we going to get another sort of extension?
My bet is we get an extension because it's not possible to deliver trade deals with every single trade partner. What that looks like, though, really is going to be dependent upon whether any countries are offering their best deals and whether Trump's even willing to listen. We've heard real mixed messages over the past few days. The Treasury Secretary says that there is likely to be a pause if we see good faith on the part of our trade partners. On the other hand, Trump said that he's sending out letters where he'll unilaterally dictate what those tariff lines will look like. So anyone's guess right now, but my bet is, especially with the new hostilities in the Middle East, we are likely to see an extension of the pause.
And Mark, the trade frameworks that were put in place during the first Trump presidency were largely held over, at least many of them, during the Biden presidency. But there was a lot of criticism that the Chinese were not necessarily keeping their end of the agreements that had been put in place. So when you're doing a trade deal, how do you ensure, especially with a partner like the Chinese, how do you ensure that they do, that that's going to happen?
Well, you have a consultative mechanism, and even the Geneva Pact that the Trump administration signed in mid-May with China, and that's really what we're reinforcing this past week, that had a consultative mechanism, or at least the promise of one. And after that, you can begin to talk about how you retaliate, how you impose sanctions on the other side for a failure to comply. But if you go back to Trump 1.0, the phase one deal, which, as you say, China didn't entirely live up to, had a lot of mechanisms, including a review that didn't look terribly dissimilar to what the WTO would offer in terms of dispute settlement. So you want some kind of mechanism that is shy of simply implementing higher tariffs on a unilateral basis. We're in a bit of a jam right now because this deal that was signed this past week isn't going to be long term, and the markets are going to be roiled again in anticipation of whether the Chinese live up to the deal in 6 months' time or whether they continue to restrict rare earths, and what the U.S. does under the name of national security.
Mark, we'll look to catch up with you again as we get more details and get past that date. Thanks so much.
Thank you.
Escalating tensions in the Middle East shaking global markets, with U.S. stocks sliding as investors lose their appetite for riskier assets, at least for now. So how does this translate into the options market and volatility? Here to discuss, All-Star Chart's chief options strategist Sean McLaughlin, as well as Yahoo Finance's Josh Schaefer back with me. And Sean is here with us in the studio, which is a nice treat.
It's great to be here for the first time. This is a beautiful place you guys have.
Thank you so much. Appreciate it. So let us talk about the VIX and volatility, because we are, not surprisingly, seeing it spike today on these headlines coming out of the Mideast. It's at about 21. Is that pretty typical now for what we see around these sort of geopolitical conflicts flaring up?
Honestly, last night when I saw the way the S&P futures were trading, I expected a bigger move in VIX. So seeing a VIX in the low 20s right now, I don't know, that doesn't raise the alarm bells for me yet. Now, this is how VIX spikes start, right? They got to start somewhere. And the next few weeks, and we have a weekend coming up, but Monday we could wake up to a VIX in the high 20s, maybe higher. I'm not saying that's going to happen, but I'm not convinced yet that the market is spooked, really spooked yet.
How does it translate to options trading specifically, right? To have a big volatility spike. Obviously, I think you're probably not planning for that necessarily, depending on where you're placing those positions, right? So like the past month and a half when we've had several of these events, how does that sort of impact the strategy?
Well, it impacts how I will trade going forward, right? So when volatility is high, as an options trader, I want to start putting positions on where I'm selling premium. I want to be short premium, generally speaking, when volatility is high. Now, I don't want to sell high. I don't want to be selling premium as volatility is rising. I want to wait for volatility to roll over a little bit, because as we've seen, a VIX can go from 25 to 30 to 35 to 50 really quickly. And if you're on the wrong side of that, that can be painful. Now, as an options trader, we have the ability to define our risks and put ourselves in a position not to get burned if we're wrong. But I still like to wait for, see a day or two of VIX closing lower and then start positioning against the volatility.
So you're not chasing on, say, like you said, maybe Sunday night, Monday we come in, the VIX is significantly higher. You wouldn't prefer to chase on Monday when the VIX is still spiking?
No, because as we've seen, when VIX spikes, it spikes fast, right? And then when it rolls over equally fast. So I'm kind of waiting for the rollover, and then I'll start making trades, betting on a volatility contraction, maybe selling put spreads in the SPY or the QQQ, indexes like that.
Okay, I'm going to ask a dumb question. What does selling premium mean?
So selling premium means I want to be collecting money for selling options. So instead of buying options where it costs you $1 a contract or $2 per contract, instead you're taking the other side. You're selling it, you're going short, and you're getting paid first, and you're betting on the value of that contract, whether it's a call or put, going down in price, and you're buying it back at a cheaper price.
Okay, so I'm interested in one trade that you told us that you're putting on right now, which it's on the SPY, and it's a call calendar spread that effectively says you think that the SPYs are going to get back to all-time highs over the summer, right?
I do think so. I've been talking with my analyst team over the last couple of weeks, and I feel like we've come back so far to not get there. I mean, what are we? We're a whisper away from all-time highs now. We're a good afternoon away from it. To not get there from here I just can't even imagine that. So yes, it doesn't surprise me if we chop around here at these levels for a little bit, especially with the geopolitical stuff going on. But for me, I got to believe that by 4th of July, we can make a new all-time high. Now, when we get to a new all-time high, anything could happen from there. We could just have a runaway gap that everyone's just chasing and they can't get in, or it could be a big rug pull, and then who knows?
Well, because right after July 4th is July 9th.
Right.
Which is the next tariff deadline.
Exactly. So it wouldn't surprise me at all to see the S&P and the NASDAQ get to new all-time highs in the week or so before that. And then the real fireworks happen.
Yeah, I actually want to bring up something that Binky Chadha of Deutsche Bank talked to us about the other day with how he thinks about the tariff back and forth and the trade back and forth. He said basically what we saw is what we saw during the last Trump presidency. When stocks go down enough, the administration reacts by sort of backing off on trade. So if we do, and then the the opposite happens. So in other words, if we get to record highs again and Trump is
Turn the
feeling
dial up.
good going into July 9th, maybe then we could see something that the markets are not going to like as much and things go back
It's
down.
funny you say that. I had the same thought this past weekend. It's interesting how when we're at the lows, we got the administration trying to pump everybody up and give good news. If there's any news at all, it's good news, right? But they're going to stay away from the bad stuff. And yes, it totally makes sense that we're right back at all-time highs. People are feeling good about their finances. They're feeling, okay, we're back off the brink. Okay, now we can start trickling out some tough stuff, some tough love, right? It makes sense to me. It's not the way I grew up following politics, but that's the way it seems to be these days.
Well, one of the other interesting things that's been going on over the last month, too, that I've been following is just the correlation between how stocks are moving, right? In early April, market was all kind of moving together, right?
Yeah.
All the stocks were moving together. And I guess I sort of wonder if we approach July 9 and get back to that sort of scenario, because stocks have that's split now, right? We haven't had a correlated market.
Right.
What if that happens again in July 9, and then how does that sort of impact whether you're putting options on certain individual stuff? Like, how does that impact how you'd individually trade stocks if there's concern that we would get back to a market where, Trump tweets and everything moves?
Yeah, I mean, markets tend to get to a correlation of 1 when people are scared, right?
Sure.
Everything trades together. Everything trades down together, and everything bounces together. So for me, if that happens, if we're in a high correlation market, it's because the market's scared. And we're going to be selling off. The VIX will be spiking. We'll be looking at high premiums again. When we have volatility spiking, what I tend to look for, and I looked for this in April and it worked out really well, knock on wood, but soon as the S&P started bouncing and the VIX rolled over pretty good, then I started selling QQQ put spreads, NASDAQ put spreads, and I was selling, selling a put spread, meaning I'm selling just slightly out of the money put and then protecting it with a further out of the money put. So it's defined risk, okay? So I know the most I can lose and I'll size my position accordingly. And I'm betting on 2 things, and I'm betting on 2 things, and I could win if one or both happen. And that is, I'm betting on volatility contracting, or I'm betting on the lows holding. No lows not breaking. If I get one of those 2, I probably make money. Certainly, if I get both, I make money. But my risk is defined, and that's the most important thing.
I want to ask you about a single stock trade that you are looking at also, and that has to do with Take-Two Interactive, the video game company. Josh talking about things not correlating as much probably gives you more opportunity too.
Absolutely.
On a single stock option basis. So what are you looking at with Take-Two?
So with Take-Two, that's a software company that if you look at the chart over the last year, it has been one of the outperforming names. It has been riding its 50-period moving average almost without fail, and it's recently come back and tested that a little bit, and it's moving its way back up, and it's one of those names that it can move $20, $30 in, once it breaks through new highs, it could get there again in a month or 2. And I'm looking at a September call spread. I want to buy I think it was the 250 calls and sell the 270 calls. I could get it for around, I think I looked at $5.50, maybe $6. I could triple my money if I get it right. And define risk.
Sean, I'm not a technical analyst, but even I can look at the Take-Two chart and understand sort of what you're looking at there, right? Some higher highs.
Number go up,
Yes,
collect.
yes.
I have an 11-year-old son, and I tell him look at a chart. Like, what's that chart doing? He says it's going up. Well, those are the kinds of stuff.
Those are the things you buy, right?
Yeah.
Sean, thanks so much. It's
Thanks
good
for
to
having
see
me.
you. Thanks for coming in.
Oil prices are spiking the most in 3 years following Israel's attack on Iran. Bloomberg Economics projecting that oil prices could reach as high as $130 per barrel. This could further escalation. This escalation, it could risk President Donald Trump's promise to lower energy prices. That's the big question. Joining me now on this, we've got Yahoo Finance Washington correspondent Ben Worschel. Ben, what is the potential risk that it could hit on his promise to lower prices, lower gas that was campaigned upon? And we have seen it play out in some of the inflationary prints, but this a major headwind now.
For sure. Yeah. Good morning, Brad. So this energy has obviously always been a touchy issue for Trump, and we saw evidence of this yesterday, even before these attacks. He was at a White House event and was expressed unhappiness with energy price increases even before last night. He even joked that he was going to call his energy secretary and scream about it. So this is clearly a top of mind issue, and what we saw is the energy prices spike overnight as a result of this. This comes in spite of the fact that these attacks were targeted to nuclear facilities, but the fossil fuel side of this is increasingly in concern. And I think part of the reason this has a lot of salience for the White House is this overall inflation question. If oil prices spike, the overall inflation goes up. It is the underpinning of a lot of Trump's economic agenda, the argument for it. Tariffs first and foremost. We had an inflation print earlier this week that was lower, pulled down by the month-over-month decrease in the energy index and a 12% decrease in gasoline over the last year. And that's Trump's case for tariffs, is that tariffs aren't spiking inflation. That's not happening. And so that's why tariffs are great. And this comes right in the middle of his negotiations over what's being called Liberation Day 2.0, where they're going to talk about additional tariffs. It's also an additional complication for Trump and his increasingly combustible relationship with Jerome Powell. He was talking about Powell again yesterday. He called him a numbskull for not lowering rates. And he said Powell should lower rates because inflation's under control. Obviously, if inflation gets less under control, driven by oil changes, it kind of upends his policy on a bunch of different fronts.
All right, Ben, thanks so much for continuing to track this, breaking this down for us. Appreciate it. Oil futures spiking, seeing their biggest gain in 3 years. And as we're monitoring the violence that's breaking out between Iran and Israel, this is prompting concerns around the outlook for supply in the region. Joining us now on the outlook for energy sector here, we've got Fernando Valle, who is the Hedgeye Risk Management Energy Analyst. Good to have you here, taking some time this morning. Just walk us through where this immediately kind of initiates some of your attention to flow into, especially when we do see conflict like this arise in the Middle East once again.
Absolutely. I think to us, the first place to look is the oil E&Ps. They probably have the most beta, and it was a sector that was beaten up already. We actually upgraded several names, including Diamondback, Matador, and Permian Resources to the long side. A couple of weeks ago, we were starting to see already a trend moving in oil that made us more optimistic. And so we moved those names higher to the long side. Now, with obviously oil coming up 8%, it gives a lot of relief, especially to the ones that have higher leverage. None of those names are particularly high leverage names, but some of the other ones on the oil E&P side, they'll get some relief because at 63 WTI, they really weren't doing so well. They couldn't grow. In fact, they should probably be declining slightly. And at 70, they get a little bit of a respite there. They can grow. They can potentially even lower their leverage over the next couple of weeks.
Occidental Petroleum, Exxon, Chevron, all U.S. energy plays, and they're all the top trending tickers right now on the Yahoo Finance platform here. How should investors be really analyzing the U.S. specific energy sector names?
Yeah, so with Exxon specifically, it's worth mentioning that they have a lot of production in Qatar gas. It's a very significant part of Exxon's earnings, which is obviously in the midst of the conflict. Qatar shares the North Field with Iran, and a lot of the exports go through the Strait of Hormuz. So there's some risk there. ConocoPhillips and Shell, Total all have participations in that field. When you look at Oxy or Chevron, they have less exposure to that area. Oxy is probably even the least out of all of them. I mentioned all the pure U.S. E&Ps. I think they get more of that leverage. And also because on the refining segment where Exxon, Chevron, BP, they're all exposed there, I think this is negative for the refining segment. And so with the pure oil E&Ps tend to do better in this overshoot of oil.
Fernando, I wonder, from what you've been able to analyze in prior instances, how long is the tail in terms of the impact that we're talking about after the initial strikes and event that sparks the volatility to the point where we eventually see some falling action, but perhaps there's still a little bit of overhang until there's real resolution that seems like it might be emerging?
It's typically not long. You've seen it with the attacks in Saudi Arabia a few years ago, and then with the October 7th. This lasts a little bit. I have a friend who always says oil always overshoots, and typically wars and attacks are a good time for you to sell because you get that opportunity to sell into strength. So we'll have to see here how long the attacks go on, but typically does not take long after these initial skirmishes before it reverses. I'll say you talked about oil. Some prognosis that we're going to $120 a barrel. As your previous guest was saying, the issue is that the consumer can't really afford that level of pricing, and so demand would come down significantly. So I would put a very short. I don't think that's a very likely occurrence that we'll get to those levels unless there's a significant shift in the economy.
Just lastly, while we have you here, OPEC Plus was anticipating that there would be a supply surge over the summer. How much can that potentially offset some of the initial move that we're seeing the markets react to right now?
Well, not much, because a lot of that surplus would have come from that region. Most of Saudi Arabia's production's on the East Coast. Kuwait, the UAE, they all export through the Strait of Hormuz. So if that is the area of concern, it doesn't really alleviate much. The other point is that they're moving the quotas, but the production itself will be below what the quota announced, the headline number, because they're really just allowing countries that have been overproducing to now match what's already there. So if they're saying about unwinding 1.3 million barrels a day, the likelihood is that we're going to get 700,000 to 800,000 barrels a day of actual production growth.
Fernando, great reminder, great context. Appreciate you joining us this morning.
My pleasure.
Let's get into today's strategy session. Geopolitical risk hitting stocks today as investors de-risk into the weekend and brace for escalating tensions in the coming days. All of this halting gains that were close to taking the S&P 500 back towards records. Joining us now, we've got Michael Reinking, who is the New York Stock Exchange Senior Market Strategist here. Michael, just give us first the pulse that you were sensing from some of your colleagues on the floor of the exchange this morning before you made your way here to our studio, and what you're hearing from them right now.
Yeah, so thanks for having me back in studio this morning, Brad. Look, so I think we're seeing the typical kind of conflict playbook. This morning you're seeing equity markets move lower, oil prices, gold higher. But there are some interesting wrinkles kind of within that. You're seeing the dollar rally, but we're not even kind of getting back to the losses that we had seen kind of as of yesterday. Treasury yields are moving a little bit higher. Typically, you'll see Treasury yields move lower in kind of that risk-off environment. But you have that push and pull of how this is going to potentially impact inflation on a go-forward basis, right? So, the move in general, though, is pretty muted. If you look at the S&P 500, right, we're essentially unchanged for the week, right? So we haven't really kind of seen a significant drawdown. Markets are going to be in kind of a wait and see in terms of kind of what the response is, how that whether how aggressive that response is, and whether you start to see kind of oil markets impacted elsewhere within the region.
It's so interesting because this is a market that has really overweighted any semblance of good news that's come forward here. And one of the areas, even amidst this bad news that's transpiring right now, is what we could potentially see in any type of materials or rare earths deal. And one of the tweets social media posts that had come out this morning was from Donald Trump, President Trump, saying that he had given Iran a 60-day ultimatum to make a deal. They should have done it. Today is day 61. Told them what to do, but they just couldn't get there. Now they have perhaps a second chance. All that considered, what is the likelihood that we see any type of deal unearthed at this juncture, and what would the markets even do with that information?
Yeah, I mean, so in terms of Iran, I think one of the surprising things was the timing of the strike last night, right? Yeah. So we were supposed to have negotiations on Sunday, right? Those are likely off of the table right at this point. So I think there was a little bit of a surprise just in terms of how quickly the strike had. But markets started to sniff this out a little bit, right? Coming into today, right, oil markets were up over 5%, right? We had the Atomic Agency say, just this week, also saying that Iran wasn't in compliance, right? So, I think markets have, somewhat, kind of sniffed this out a little bit, but, we're not necessarily kind of seeing kind of that big risk-off move at this point.
What are the hallmarks of that safe haven playbook that you were talking about, investors really thinking through and activating here this morning on the back of this?
Yeah, so I mean, we're in terms of kind of the safe haven move, right? We're kind of, you're seeing kind of strength. It's not really a safe haven, but the obvious move into energy stocks, right? You're seeing travel-related names, kind of under pressure. And then you're seeing, kind of some strength, kind of within that U.S. dollar, the U.S. dollar. I know you've spoken a couple times this morning, with some of your guests about, the idea of the Mag 7 being, kind of a defensive sector. We've seen that, kind of, over the last couple of years that investors have moved that way. And if you think about it from a perspective of, this isn't going to derail, kind of the AI demand that's out there, right? So it's sort of, insulated from any, from this sort of geopolitical risk, right? And we also had, kind of very, very solid numbers from Oracle this week, pointing to just the insatiable, kind of demand and kind of, that they continue to see, across that space.
I want to hit on two more themes while we have you here, or two more major topics that the market is really weighing through. One of them being what you and I were talking about in the break when you came on set, which is, we made it through this auction week for some of the 5, the 10, and then the 30-year bonds, and the 20-year, that might be a nothing burger when that comes about. We will see, but overall, we kind of were able to make it past that and still see a sense of demand, not just here, but also internationally here. I was looking at this chart from Apollo chief economist Torsten Slok, where he said that foreigners have reached record high exposure to duration in U.S. Treasury markets. What's the significance of that demand and the interest that we're seeing right now?
Yeah, and so, I mean, that was one of the concerns that we had over the last couple of weeks, right? We had seen kind of the weak auctions, kind of out of Japan, kind of trigger some more concern into our last 20-year auction. That's, as we sort of mentioned off air, that's kind of an orphaned kind of product. So, we had, that little bit of volatility right after our last 20-year auction. But this week was very important in terms of seeing kind of very strong 10-year, the very strong 10-year auction, and yesterday's 30-year auction. Next week, we have some really big catalysts, right? As we move into kind of the central banks, we have the BOJ on Monday night. I think while they're expected to leave rates unchanged, investors are going to be paying close attention in terms of kind of if they try to use any rhetoric to kind of talk about kind of containing the recent move higher in longer dated yields, kind of there. And then obviously we have the Federal Reserve, who's kind of got a new bit of risk to kind of contend with after today's action.
I only get 15 seconds. One of our guests earlier had said we're in this wait and see from the Fed. That's what we continue to hear. And this event that's transpired overnight is the C. So what do you think is going to happen once we get to that mid-June meeting?
Yeah. So look, I think this adds a little bit of uncertainty. They're still in a wait and see. It's going to add some uncertainty for the Federal Reserve, right? They're not going to change their stance, right? I think the inflation data that we had seen this week was somewhat encouraging. There is some skepticism, right, looking at that data, because we're not seeing the impact of tariffs, at this point. But what that does kind of help the Fed do is point to the idea that you've seen, kind of the disinflationary process, kind of in place, kind of ahead of tariffs. Right. They may start to kind of set the table to, for a fall, rate cut. And by setting, I'm talking about kind of putting the tablecloth down. Sure. Right. July might be kind of the silverware and plates. Interesting. Right. And so I think you could start to see a little bit of softening of tone. But now you have this oil shock, which potentially will feed through to the inflation numbers as well that they're going to have to contend with.
Michael, great to see you as always. Thanks so much for taking the time.
Thanks for having me.
Certainly. Geopolitical risk rattling investors and global financial markets this morning. So, how should investors on edge prepare for increasing geopolitical tensions? Joining us now, we've got Alex Morris, FM Investments CEO and CIO. Alex, good to have you here with us today. Just help us make sense of what we're seeing in the region as it is, of course, being evaluated through the lens of investors here this morning.
Yeah, certainly some terrible things happening across the world, and investors should take note of that as we think about how do we position our portfolios, but just the overall theme of what's happening, right? Geopolitical tension is up. Things are getting less certain, not more certain. And as a result, it's not the time to be taking outside risk. This is a great time to be looking back to your asset allocation and to be really processing how do you want to be positioned for when things go wrong, which is something we often talk about, but we actually seldom actually implement. So this isn't the time to be taking out leverage into the long end of a Bitcoin trade. This is a great time to be going back to basics and sticking to the asset allocation and trying to see past the next 2 or 3 years.
Worth noting, Alex, that this comes just after the S&P 500 hit its highest close since February 20th, which was just one day after the benchmark index most recently set a new record closing level. We were reporting on that on Yahoo Finance yesterday into and after the close here. And now you have this move off of those levels driven by, once again, more uncertainty internationally here. What is the risk that this actually spirals into something more large that investors also have to take into consideration?
Well, I think this is a reminder of what was always going on. I suspect if you ask the Israeli high command, they would tell you October 7th was a declaration of war, and they've been at war for a long time. This is merely a new front. But from an investor, we're looking at some other stats as well. We are going to hear from Jerome Powell later today. We don't expect to see any cuts, but I do think we are going to hear about softening some language, and cuts are probably the only thing that are more certain as a result of this. The question is now when. It's not today. Will it be just after Jackson Hole? Will it be nearer the end of the year? We look at CPI that's going up, so the cost to consumers is going up. The producers are going down, which means that corporate margins are somewhat being squeezed. So we're starting to see other little cracks, and this is what the deterioration of the economy looks like. It's happening in slow motion, and Jerome Powell's almost schoolyard logic of in January of let's just wait and see. Well, this is what the C looks like. So now we're going to get an interesting opportunity for the Fed to actually try to engineer that soft landing. And the technocratic job they have to do in making that happen certainly gets much harder when political forces say cut rates now, cut them by 2%. And then on top of that, geopolitics seems primed to spike oil, which doesn't in fact to inflation, but also just add net uncertainty to a market that was just starting to find its feet again.
I wonder, has the profile of safe haven areas of the market changed dramatically? And the reason I ask that is because of where we're already seeing overcrowded trades within the market as of right now, both long positions and those who have kind of looked across the tech industry and the Mag 7 and said, hey, that might be the new safe haven if we're just sitting in a position long term anyway.
I think a lot of folks have made that trade for the last few years, certainly post-COVID, and it's probably a great place to be in that sense. If you define safe haven as something that I could also call a safe haven in 1950, then maybe not. But practically, if what you want is that 5-year over the horizon view of things, a tech stock, the Mag 7, they're probably not going anywhere. Certainly you are going to see some volatility, in certainly a name like Boeing, the defense stocks that you showed earlier in the show. You're going to see some action there. So short-term profits to be made taking those types of risks. But long-term stability, we're still going to have our iPhones 5 years from now. And that's probably the one thing that we can count on.
Yeah, not if Sam Altman and Johnny Ive can say anything about it, but we will see what they put forward.
See.
Yeah, exactly. Alex, thanks so much for taking the time here with us today.
Thank you.